Everyone thinks global markets are driven by intelligence, by forecasts, by complex models built by very serious people. They're not. They're driven by one rule so simple it sounds insulting. Markets don't move based on what's true. They move based on who needs cash right now. And once you see that, a lot of things stop making sense and then suddenly make too much sense. Right now matters because we're living in a world that looks calm on the surface. Stocks recover. Currencies wobble but survive. Crises come and go on a schedule that feels almost rehearsed. Yet underneath, leverage is higher than ever. Debt is larger than at any point in human history, and nearly everything we call wealth exists only as a promise that someone else will pay later. That's not a moral judgment, it's a mechanical one. To understand the rule, we need to start with a story that's older than modern finance. Imagine a crowded marketplace. No screens, no algorithms, just people trading goods. One day, rumors spread that a storm is coming. Some traders want to hold, some want to sell. But here's the catch. A few traders borrowed money to buy their goods. They don't get to wait and see. They have deadlines. When the lender shows up, belief doesn't matter. Only cash does. That dynamic never went away. We just hid it under layers of sophistication. Modern markets are that same marketplace, except almost everyone is trading with borrowed money, and the lenders are invisible. Here's how the system actually works. Most market participants don't own what they hold outright. Banks, hedge funds, corporations, governments, they operate on leverage. Borrow short-term, invest long-term, roll the debt, repeat. As long as credit keeps flowing, everything looks stable. Prices rise. Risk feels manageable. People confuse momentum with safety. But the moment cash tightens, the rule activates. Assets don't fall because they're bad. They fall because someone needs to sell now. This is why markets crash in ways that feel irrational. During crises, perfectly healthy assets collapse, not because their future changed overnight, but because their owners lost access to funding. In 2008, banks didn't fail because housing instantly became worthless. They failed because short-term funding evaporated. In 2020, markets didn't crash because the world permanently ended. They crashed because margin calls don't care about pandemics. Liquidity is not confidence. Liquidity is permission. Permission to hold, permission to wait, permission to survive long enough for long-term to exist. And here's the uncomfortable math. Global debt today is over 3 times global economic output. That means the system only works if refinancing never stops. Every major market, stocks, bonds, real estate, currencies, depends on the same assumption. Someone else will roll the funding tomorrow. That's the rule. When cash is available, narratives flourish. When cash disappears, narratives die quietly. This is where the irony comes in. Public conversation focuses on headlines, elections, earnings, inflation numbers, central bank speeches dissected word for word like sacred texts. But markets often move before the story changes. Why? Because funding conditions change first. Interest rates rise not because inflation is scary, but because lenders demand compensation. Currencies collapse not because countries are evil, but because foreign funding pulls back. Asset bubbles burst not because people wake up smarter, but because leverage hits a limit. The hype tells you markets are forward-looking. The reality is they're cash-constrained. Take government debt. Governments don't default when debt is too high. They default when refinancing fails. That's why some countries survive massive debt for decades, and others collapse suddenly with far less. The rule isn't morality, it's mechanics. The same applies to corporations. A profitable company can die from a liquidity freeze. An unprofitable one can survive for years if funding remains cheap. This feels backwards until you remember the rule. Markets obey cash needs, not balance sheets. Now zoom out. The global financial system is built on a hierarchy of money. At the top sits the safest collateral, government bonds from trusted issuers. Below that, riskier debt. Below that, equities. Below that, everything else. When stress appears, money moves up the hierarchy, not to what's best, but to what's liquid. This is why safe assets get more expensive during crises, even when governments are clearly worse off. Safety is not about strength, it's about sellability. And this is why central banks matter so much. They don't control markets through wisdom, they control them by controlling the availability of cash. When central banks inject liquidity, markets levitate. When they withdraw it, markets suffocate. Not because investors change beliefs, but because funding chains tighten. This leads to the most uncomfortable contrast. We're told markets reward productivity, innovation, and long-term thinking. In reality, markets reward whoever can survive the longest without being forced to sell. That's not cynicism, that's structure. Long-term success often comes down to short-term liquidity. Which brings us to the risk most people miss. As debt grows faster than real economic output, the system becomes more sensitive to small disruptions, a tiny rise in rates, a brief funding freeze, a political shock that delays refinancing. The more leveraged the system, the less room it has for error. Stability becomes brittle. Everything works until suddenly it doesn't. And when it breaks in places that feel unfair, not where the risk was obvious, but where liquidity vanished fastest. This is why financial crises always feel surprising and obvious at the same time. Surprising because the story didn't change, obvious because the funding did. So what does this mean going forward? It means markets will continue to look irrational to people watching headlines. It means asset prices will keep moving in ways that contradict fundamentals. It means power will increasingly belong to those who control liquidity, not ideas. And it means the most important economic question is rarely asked out loud. Not is this asset good, not is this country strong, not even is this system fair, but something far simpler. Who needs cash next and who can afford to wait? Because in the end, every global market obeys that rule. And the uncomfortable question is this. As debt keeps growing and liquidity becomes more fragile, how long can everyone keep waiting at the same time?